Monday, April 30th, 2018, Monaco 64, home of alternative economics and contrarian views. So I'm going to look at the markets as usual, and I want to talk about financial repression and look at European government bonds and how Mario Draghi, the president of the ECB, basically killed capitalism back in 2012, and how he's like punishing the European public, the general public, for keeping a monetary system, financial system alive that doesn't deserve to be kept alive. And the same thing goes for Bank of England, even the Fed, even though interest rates in the US have gone up. But before that, let's have a look at what we're doing this morning in the markets. It's 8:08 a.m. London time. We've got spot gold down again, surprisingly not. We're down 6 at 13.17. The high's been 13.25 overnight, and we are right near the lows here, 13.16.84 now. Silver's down 10, 16.40. The high's been 16.56 and the low is 16.29. I noticed on the open that silver like dumped big time from like in the matter of seconds, but then it rebounded back up. I don't know if it was a fat finger or more shenanigans by the bullion banks. The Dow is up 103 points, 24,412. S&P is up 10. So stock markets are up almost 0.5%. The NASDAQ 100 future is up 0.2% at 6,697. Currencies, the pound is continuing lower. It's at 137.70. We had really no very bad figures for UK GDP, and that's why the pound dropped a lot on Friday. Looking at the longer term chart of the pound, the key support longer term is around 136.50 at the moment. So that will be a key level to keep an eye on. We are, of course, at 137.60 at the moment. So still quite far away from that level. The euro is at 121.33, unchanged. The dollar is up a little bit, almost 0.2% against the yen. It's at 109.22. So that seems to be, I've spoken in the past how the a weakening yen is usually good for bad for gold and silver, and that seems to be happening at the moment. Dollar, of course, got down to as low as 105 handle recently, and now it's rebounded to 109.22 against the yen. Interest rates, well, the 10-year yield is just below 297. We've, I think this is like a retest of the 295. I'm not sure if the U.S. bond market is out of the woods, if we're going to be able to stay below 3%. And I'll talk about the European government bond market and what happened in 2012 and before that, and what I think might be happening in the U.S. So, and I want to talk about financial repression. What is financial repression? In my opinion, it's the policy of keeping the public in the system by punishing them through artificial interest rates, through, how can I say, manipulated prices of some certain assets like gold and silver, so they don't have an option to like protect themselves against the debasement of the currency, by, how can I say, keeping interest rates for the public very high if they want to borrow money, if they need to supplement their income, by allowing governments to crowd out the markets, the free markets. And what do I mean by that? Well, crowding out, that means that the government is like being protected by the banking system, the financial system, the monetary system, and they're all like, they scratch their backs, the bankers, the politicians, and it crowds out the economies. That's why you have in Europe the public spending, the government is, places like France is almost 50% of GDP. They think, the bureaucrats in France and other countries and even here, they think they can do better than the market. And they punish people that want to start businesses. They keep taxes and regulations high. You could argue that the UK voted to Brexit because of that, but I don't think anything will change outside of the EU when the UK is outside of the EU. Do you really think regulations, VAT, taxes, council tax, business rates are all going to drop, and all of a sudden the UK establishment is going to let the public try to become self-sufficient and independent? I don't think so. So that's what financial repression is. And it's even worse after the 2008 crisis and the 2012 crisis that we need to talk about as well, which was the European government bond crisis, which would have brought down not only the euro and the whole system in Europe, but the whole fiat money system. It would have brought down the UK, the US, all the Western countries. And I think that's why we had the whatever it takes moment by Mario Draghi in July of 2012. Before that, though, I want to look at where interest rates in Europe are right now. I'll look at the 10-year yield. So for example, in Germany, the 10-year yield is less than 1%, 0.59%. So that's the equivalent to the US 10-year yield, the Bund yield, 10-year yield, which is now almost 3%. So there's like a almost 250 basis point difference. I remember when I worked in the markets that if that differential got to 100 basis points, it was time to buy US Treasuries and sell Bund. But now we're at 250, so there is something completely out of whack there. And German cost of living, or CPI, is rising by more than 2% per annum. So the German saver has been, how can I say, abused or like ripped off. But at the same time, the central banks and the bullion banks, or the major banks, they manipulate the price of assets that could help savers like gold and silver, so they don't get out of the system. They want you to keep your money in their system, and that's why they manipulate prices, and that's why Mario Draghi did what he did in 2012. I'll get that to in a minute, but I'm just to give you an idea of what's been going on. So the German yield is less than 1%, inflation more than 2%, so you're losing out. France, 0.81%, same story. Less than 1%, France. It's amazing. The ones that are even more amazing to me are the pigs. That's how they use PIGGS. They used to refer to the countries in the European periphery or in the Mediterranean and Ireland that were going bust, and they used to call them pigs. Portugal, Italy, Greece, Spain. I forgot the other one. There's two G's, but so let's have a look. Italy right now. You might say, oh, that's not bad. It's higher than the German yield. It's 1.76. Believe me, that's like totally artificial. Spain again, 1.27%. Portugal, 1.64%. And Greece, I mean, Greece is bankrupt, and their interest rates, I'll talk about the pigs in a minute, their interest rates were in double digits in 2012. And now Greece is almost paying the same to borrow money as the United States. It's a joke. So that's why there is unhappiness that's the consequence. That's why the political picture in Europe is getting more and more extreme, and it's got nothing to do. It's the consequence of central banking policy and the monetary system. It all boils down to that. That's why we're getting extremists on the left and on the right in Europe, and it's not going to improve. And it's all been done to save a few thousand, well, tens of thousands of people who benefit from the central banking system, to save the elites, the establishment. So now I want to go back and look at, I'll start out with Spain. Spain, of course, right now is 1.26%, the 10-year yield. But in 2012, in July of 2012, the 10-year yield in Spain got up to 7.7%. And I remember that was just before I left the city, before the firm I work for closed down my desk. I was there till like May 2012. So I was looking at that, and I was like in awe, because European, and this was because if you look at the euro, before the euro in the early mid-90s, the interest rates in these countries were where they got to in May 2012. The Spanish 10-year yield was at 7 or 8%. So the Euro project actually artificially lowered those rates, because people thought, oh, there's going to be less risk because Spain, Italy, Portugal, they're going to be part of the Euro. So it was almost like a, collateral CDO for currencies, because you had AAA Germany, and then AA France, and the junk. But it was all combined, and it was made into a AAA. But now this idea that you could create this single currency, and it would be, there would be no risk, and you could buy anyone's government bonds, that was falling apart in 2012. So the Spanish yield got almost up to 8%. Italian, for example, got to the same level, 7.5%. To me, though, it wasn't surprising, because I remember the short-term Italian interest rates in the early 90s when I started out in the markets. That was 10%. So it was the unraveling, of course, of the euro here. And the whole fiat money system, I would argue. Portugal, that's the interesting one. Right now, Portugal, you only get 1.6%, almost half of what so the Portuguese government is having to pay only half of what the U.S. government pays to borrow money, or just under half. And in 2012, that rate got up to 16.5%. So it's amazing. It was all unraveling. And then let's have a look at even France. France, 2012. Yeah, it was rising. It wasn't as high. It was going back up to 4%. And the reason why the French rate wasn't rising as much as the periphery, the German rate was actually going lower, is because people were fleeing away from those countries, and France was considered to be better risk, but not as good as Germany. So that's what was happening. But then all of a sudden, and I've got an article here from QZ.com, Quartz Media, the whatever it takes moment. And it says, 5 years ago today, Mario Draghi saved the euro. So this is actually from last year, July 26, 2017. And it says, exactly 5 years ago, European Central Bank President Mario Draghi demonstrated the power of words. The Eurozone was in the throes of crisis, the bailouts of debt-laden members pushing the currency union to the verge of collapse. Yeah, it would have collapsed the euro, but it would also have collapsed the whole global banking system, because the European banks are interlinked. They're like dominoes. European banks go, UK banks go, US banks go. So it says, but with a simple, seemingly off-the-cuff phrase, Draghi fundamentally changed the course of events. Whatever it takes. At a speech in London on July 22nd, 2012, the ECB president gave an account of the Eurozone economy. Bond yields of weaker Euro member governments were soaring. Just what I was talking about. And traders doubted the national Euro or EU level institutions could get their act together in time to avert disaster. Draghi sought to convince international investors that the region's economy wasn't as bad as it seemed. He then made the momentous remark, and I quote his comment. He says, "Within our mandates, the ECB is ready to do whatever it takes to preserve the euro, and believe me, it will be enough." So that basically capped the European rates and started all the money printing by the ECB. And prior to that, the ECB wasn't doing QE because the Germans were always against that, but the Germans had to go along with it. And I guess the Germans realized that a weaker euro and all the money being pumped into the system would help them. And nowadays, President Trump goes around criticizing Germany about their trade surplus, but he needs to criticize the central bankers. They're the ones who are manipulating everything to keeping currencies devalued. Look at the Swiss National Bank. It's a crazy national bank. They're just like printing money and buying stocks out of thin air. Imagine if you could do that. So that's financial repression there. And that's why the public is getting more and more dissatisfied, because this is done to keep the financial oligarchy, the establishment, the fund managers, the traders, the bank employees, all going and making profits, and the government's borrowing as well. But the general public is suffering because they've killed the real market. There is no real market anymore. And when is this all gonna implode? Difficult to say. I mean, the Soviet Union didn't last. Well, it lasted for quite a while, and they manipulated everything. They didn't have a market. It imploded. Hopefully, this won't last as long as the Soviet Union. Soviet Union lasted about 70 years. We've been at this for about 10 years. So that's it for now. I hope you had a good weekend. And if you enjoyed this video, please like, share it, subscribe to my channel if you haven't yet. You can also follow me on steemit.com and on DTube and on Twitter. And if you want to get notified of new videos, make sure you click on the little bell. I'll talk to you later. Take care.